Good day to everyone. This is Joseph Trevisani from Worldwide Markets. Thank you all for attending, whether it's daytime, noontime, or evening time. And today we're going to look at the analysis preparation for trading that I would have done, not that it's particularly me, when I sat down on my trading desk. I'm trying to do this from a point of view as if we were all not quite new to this, certainly, but new to the desk in the morning. I'm going to start with sort of the fundamental background. I think there are two aspects to analysis and trading, certainly when you're talking about prop trading, which is what we all do. One is the background, the, if you will, current scenario that is playing in the markets. When I first started trading and I sat down on a trading desk for the first time in my tweed jacket because I was new to the business and hadn't bought a suit yet, one of the traders said to me, well, you've got to have a view. I had no idea what he was talking about. But what he meant, it took me 2 years to learn it, but what he meant was that there was at any one time, almost always, not always, there are times when the markets are so undecided and so uncertain that no one quite knows what's going on. But most of the time, certainly in a period of low volatility like we have seen for the past several months, I'm talking particularly about the euro, but in other currencies as well, and in other markets as well, interestingly enough. There's a general idea, a general view of what's going on. This is more the fundamental view. What's happening in politics, what's happening in interest rates, what's happening in the various countries' economies. And until this view changes, it backs up and becomes the secondary view on almost anything. For instance, if you look at this chart right here during this period here, this is a euro. We're going to do the euro first. I'm going to do the four majors today. And if there's interest, then I can certainly do some of the more exotic, interesting, esoteric, whatever you will, currencies. These charts are Bloomberg. For my mind and for my money, that's certainly the best charting system that's out there. But of course, Bloomberg is a primarily market-based system, meaning it's used mostly by professionals, and it's quite expensive. So I don't know that it's an option for many retail traders, but it is a very good system. And I've been using it for many years, so I'm used to it. That's why I'm drawing on this. We're talking about the euro now. Just as an aside, if anyone has any questions or comments, considerations, or anything, please type them into the chat, and I'll be glad to stop and answer them. This is not the type of topic that we're unfamiliar with, all of us. So I don't feel the need to lecture on this. If anyone has any other ideas, disagreements, questions, please type them in, and I will do my best to answer them. So now, we were dealing, to start with the euro. So what is the background in the euro? And what does the background mean, the current scenario in the markets? Right now, certainly going back to last year. Actually, if you change this chart, watch this. It's one of the reasons I like Bloomberg. Okay, this becomes a 2-year chart. This is the real background that we're talking about in the euro. Look at this. This is a lovely, lovely trend. It has considerations to it, which I'm going to talk about in a minute. But this is in the trend of the euro since the summer of 2012. And what happened in the summer of 2012? Well, of course, that's when Mr. Draghi made his famous promise to do anything necessary to save the euro. Since then, one must admit the markets have believed him. The background trend in the euro has been up since then. From whatever this is right here, this is about 120.43, all the way up to 39.93 just last month. That trend, once established, backs up all of the decisions. You add it to your analysis, It doesn't mean that you choose your entry or exit point based on it, but when you're deciding whether or not to stay long, or frankly, more importantly, whether to go long or short, that is what you look at. That backs up what you're saying. So let's take a look at this. We see this trend from, and remember, I'm approaching this as if we are sitting down over here at our trading desk, trying to decide what to do. Here's another support line we can look at here. A less important one, but nevertheless one. You can see these are all converging over here. When you, now these are candle charts. I'm going to draw on the older type of charting analysis, which are bar charting. But I'm using candles. When you use any type of charting system, whichever one you use, candles, bar charts, whatever you want. This includes indicators and everything else. My theory, the way I've always traded, is that you look for as much reassurance is one way to put it emotionally, or concurrence with any particular trading idea. So you look for the candle formations. You look for the bar chart formations, these lines, trend lines and things like that. You look for confirmation in indicators, certainly in moving averages and some of the oscillators. The idea being that the more support you have from different categories of indicators and formations, the better off you have. Think of it this way. If every indicator had and every formation had 3 supporters out in the world, 3 people who followed it religiously, the more of them you get involved, the more people are going to act on a certain idea when it comes to that time. Therefore, you are enlisting the self-fulfilling aspect of what's going on in trading. So remember that. What you are looking at in charts are not predictors. They are predictors. They're not predictors of movement. They're predictors of behavior. You're making assumptions that everyone else in the market, or at least a preponderance of people in the markets, looking at a particular currency, will take an action, and you want to participate in that action. If we get to a certain point and nobody does anything, then the markets don't move. These seem very simplistic points of view, but they are important because once you understand and sort of absorb the idea that the markets are not separate entities, they're a reflection of all of its participants, and one of those participants is you. So if you can find the analysis of your own that matches the markets, which is your job, then you will have a much better chance of participating in the profit move, because after all, that's what everybody wants. So the background here in the euro has been a steady uptrend. And that uptrend has maintained itself over almost 2 years. Through this period, of course, the Fed was buying, actually started in 2013, so it's not only there, but the Fed was buying also all of its quantitative easing and all of that, which is, we should not forget, rate policy. So what is with the big switch here last month? We remember that the background here has started to change. And this is real what we're seeing. It hasn't gone dramatic yet. It hasn't run back through serious stop levels yet. But the background is what's changing here. The background being that Mr. Draghi and the ECB has started to pay, not started, but they have made long attacks, if you will, from policy on deflation. When we look at the European economic situation, the only country that's doing it decently is Germany. in the EMU. Everybody else is kind of moribund. They're not doing very much. And because there's no demand, there's declining inflation. Now, the problem with this fundamental picture is something that we can look at in Japan and in the United States. Central banks are limited, but the move here, this primary move here, has been because the ECB has been both promising and delivered a little bit on policies to fight deflation. So the fundamental question we have to ask is this a change in the scenario, in the fundamental scenario between the euro and the dollar? And I have to say that so far, the markets are not quite buying it. Yes, we have a decline from 1.4 down to, we touched 135. So that's a 5-figure decline. That's a pretty decent decline in this amount of time. But there's a long way to go. There's 15 more figures down to 1.2. And if we bring the chart out further, 3 years, we'll have to bring it out to 5 years, actually. You can see that we have a down to 1.2. So these two charts right here, these two lower points are really not that different in the longest run of things. So we have basically a 15 figure potential before things get really interesting. There's one problem with this, with the Bloomberg charting. When you switch views, lose your charts. But I'll put them back. That's pretty easy to do. Okay, so the question is, do we have a true change in instantaneous, if you will, change in scenario? And it's my idea we don't. But let me show you what an instantaneous change in scenario looks like. One which was also followed up by a great change in the world. This is my favorite example. I've used it before, but it actually is the best one that I know. Excuse me, we'll just get rid of this. Okay, here we go. This is the best change in a scenario that I know of. Okay, we're going to go 5 years in the euro and then a little bit further. Okay. Summer of 2008. We remember the subprime crisis in the United States. Mr. Bernanke had already been reducing rates for some time. The ECB has been saying, what me worry? Jean-Claude Trichet. Right about here, the ECB actually raised rates. And then suddenly we have this. This date is 7/15. This date is 9/11. 2 months. We go from 60.38 down to 39, 38 actually on a low. 30 huge figures, right? So what changed? Up to this time right here, the Europeans had been saying, and the scenario was that everyone accepted, everyone was trading on, that the subprime crisis in the United States was not going to affect the Europeans. Their banks were insulated, and their economies were doing, if not great, just okay. I've told this before. I had friends on Wall Street who worked in asset backs and all of the types of securities that were sold worldwide, and later proved to be very, shall we say, inflated in their valuations. And they would always tell me, when I would tell them that what the euro was doing and what the ECB was saying, they would say, Mr. Trichet has lost his mind, or something along those lines, depending on how many drinks we had, I suppose. The idea that the European banks are insulated from this is crazy. And they say, we don't know this from government figures, we know this from our own trading desks, because the bonds that we have created and sold have been marketed and bought by the boatloads from European banks. So the European banks, in their mind, were very, very weak and vulnerable. At one point here, Mr. Trichet said simply, he didn't say, we have problems. He didn't say, we're going to put in a TARP program or anything like that. But they said at one point, said very simply, European growth is not going to be as strong as we expected. That's all they said. And you get this. Remember, this is before the big debacle in equities, before things really hit the fan. But what that one statement was, mild as it was, it undermined the entire scenario that the markets had been trading on in the euro up until that point. Very logically, they're saying, well, central bankers are masters of understatement or no statements. So when Mr. Trichet says it's not going to be quite as good as they thought, what does he really mean? At any rate, everyone decided, and you can see that the acceleration took place right around here where the lows had been. The scenario changed. So now the question we have to ask, let's go back to a 3-year view here in the euro. We'll do a 2-year. Is this a scenario change? Has what Mr. Draghi said about the focus of the central bank on deflation a scenario change? Remember, scenario changes become evident generally after the fact, not when they are noted. Let's put our lines back up here. Okay, so here are the changes that we had seen. Now, when you expand this view, I'm going to put in 2 more lines here. Actually, I'll put them on when we do the view. So this is what we're looking at in the euro. The consideration 1, do we have a change in the scenario? It's my estimation that yes, we do. One of the backstops of the ability of the euro, and I actually just gave a presentation on this at Online Trading Academy for FX Street last week, and I'll tell you some of the things that I mentioned. The presentation was on volatility, and are we seeing a systemic view? And if you do some averages here, except for 1 or 2 days here, the average, and maybe this day here, the average range, as we all are bemoaning, I'm sure, as traders, certainly in the euro right now, and I use the euro because the euro has the greatest amount of volume, have been diminishing. Does this mean, as I posited the idea or the thought, that quantitative easing in its affluence, or effluence, I guess you would say, efflorescence, has done something in the financial system and the markets that has diminished volatility? That was because after all, the focus has so much been in the markets on volatility, on quantitative. Everything's getting blamed on quantitative easing. Stock market's going up, quantitative easing. Lack of volatility, quantitative easing, on and on and on. And I'm not really buying it. My point to this was it really quantitative easing that had caused some sort of systemic reduction in volume, in volatility and volume? Certainly the volume in the equities markets, if you look at it, is much lower. It's been declining. Or is something else going on? For the euro specifically, I don't think that there is or has been any sort of systemic change in volatility. But what we are having has been practical, if you will, market flows that have counteracted the fall in the euro that would be predicted by this change in scenario here. Remember, look at the difference in volatility. Okay, this is where we got summer 2008. Let's take a look at this. Come here, you. Sorry. So this is 2008. This is 6038 to 23. I can even do this one here. Okay, this is 6038 in the mid-July. And this is July, August, September. This is 2 months. Okay, and we have, and that's a scenario change. So we have 60.38, 38.83. That's a 21 big figure move in 2 months. It's kind of volatility we all love. Okay, so let's look over here where we are now. This is May 5th, and now we're June. So we're about a month, and we've had a 5-figure run. The idea that the central bank has posited that they're going to be doing whatever's necessary to bring inflation back up, if it is not as dramatic and the situation is not as dramatic as it was back in 2008, it is nonetheless, in my mind, a scenario change. The central bank policies, it's been very evident, are in the United States and in the ECB, are diverging dramatically. And this is not a usual situation because the world more or less has moved. If you look at central bank rates, I could put them up, but it'll take a while. In the past 5 years, there's an enormous convergence, both in rates and in timing. Everybody's doing the same thing at the same time. And now we're approaching a situation 5 years in where the two of the world's major central banks, bankers to the world's two biggest economic areas, the United States and the EU, EMU, are diverging. Why is not the euro down 20 figures as soon as this became obvious? ECB, they just cut rates. The Fed is attempting, or at least its next rate move will be a rate hike. So why aren't we seeing this move? And I'll tell you there are a couple of things involved. Practically, and this is what I spoke about in the FX Street, the OTA presentation, there have been a number of factors over the past, say, 6 or 8 months that have kept the euro on the boil. And the primary one have been investment in European bonds and European equities. Once it became very evident and the markets began to believe that there wasn't going to be any more defaults, after all the Greeks did default, any more defaults in Europe. And with rates low in much of the developed world and going down in some cases, why not, if you're managing a portfolio, get the return on Spanish bonds or Italian bonds twice, 3 times what you were getting a couple of months ago as to what you're getting in U.S. rates or German rates. But I'm talking about overseas here. So the demand for European investments, and you can look at the converging rates. I'm not going to put them up again because it'll take a little while to put it up. But look at the converging rates on European equities. I'll try to answer that. When you say I'm bearish at the beginning of the year, you're talking about euro. I'll answer that in a second. It's actually very much a part of this story. I was one of them, so I do have to answer that. The convergence in the European bonds. If you look at we'll just one up, okay? See if we can find this here, and I'll show you what I'm talking about here. It's actually pretty quick, so let's see if I can do this quickly. Okay, so we'll do US 10. Whoops, sorry, wrong keyboard. I've got several keyboards on my desk here. US 10. Okay, this is the generic US bond. Okay, the 10-year. Let's put a 3-year on it, and we'll compare it, say, to the Italian 10. If I can remember what that is. Italian generic inflation, generic 10-year. Okay, this is the generic Italian 10-year. Okay, you know what they did? It's on two different scales here. Oh, there is a way to do that. Hang on. Normalization. Hang on. See if I can get this one right. There we go. How about that? I'm impressed. Took me half an hour to figure it out the last time, and I figured it out. So this is what's going on here. This is a type of movement that has been supporting the, and if you look at the time frame here, the change started when, and this goes to your question here, why were people bearish on the euro, as I was from the beginning of the year, and what happened? Okay, this is what's happening. Okay, from about December, look at that date, December 31st, look what happens. The Italian rate goes down. What drives bond rates down? Bond prices going up. What drives bond prices up? People buying them. The scenario from December through this period here that I was positing, and many others were positing too, which is talking about the bearish on the euro, which did not happen, was that even at that point, 6 months ago, it was clear. Remember, the Fed started tightening, reducing QE on December 18th, if I remember, after slapping the market around back in October for getting ahead of itself. I would call that the Bernanke slap, but apparently it hasn't taken off as a term. The direction of the markets, of rate policy, was evident. European inflation was declining, and it got worse despite what the ECB was saying. U.S. economy appeared to be getting better, or at least the Fed was telling you that it is getting better because the Fed started cutting down on quantitative easing purchases. Those two factors are diametrically opposed rate policies, and they were evident, although it's much stronger now, they were evident from the beginning of the year. But what happened? This is what happened. In the new year, hedge funds, traders, everyone does their P&L year to year. I used to be, for 15 years, I sat on a bank trading desk, and my P&L was every year. You look at it every month and every day, but your biggest period, the period which determines your bonus, and for hedge funds, your measured returns against the market is year to year. So what happened in January? And the analysis through here, well, everybody's saying, look, not everyone, but people are saying it's becoming clear that there isn't going to be another default in Europe. The ECB is going to prevent it. So if we want to improve our returns, what do we do in the bond portfolio? We go overseas and buy European debt. And when you buy European debt, what do? If you're doing it in the United States, you sell dollars and you buy euro. And throughout this period here, as the rates declined from 4 to below 3 to almost 2, went down to, I think, 2.6 at one point. It's a pretty big move for bonds. Remember, these are bonds which were shunned by the market. Look at the rates back here, 7%. You could do this on the Greek rates. You could do this on Spanish rates. You can even do this on French rates. You can't do it on German rates because nobody ever worried about the Germans defaulting. So this period here is a period of continuing and relatively heavy, although I don't have volume figures, they're very hard to come by, purchases of European securities. You can look at European equities, and you'll see a similar pattern. The equity markets have been rising pretty steadily, but the timing is different. U.S. markets rose first, Europeans later. European markets rose in this period here, but primarily in this period here. Again, all of the funds around the world looking for return have been in European markets. And that rather than so the decline in volatility that we're seeing here, and the reason that the euro didn't fall despite the fundamental obviousness or the obviousness of the fundamental situation is because of this support for the euro given by actual real trade flows. You know, what we're used to in the markets, certainly the currency markets having, 95% of all the flows or all the activity in the currency markets purely based on speculative trading. That's true. But it's also true that a concerted, even if not planned, meaning market-wide, movement based on trade flows, I'm calling them trade flows, they're not really trade flows, can also have an effect in the markets. And this is what we're seeing. So the period from here to here was not necessarily a period of systemic low volatility, although there probably is some of that because you're seeing that in equities as well. But the largest point of view, the largest cause for this has been a balance. Even though it appears from analysis that the euro should be declining rapidly, was because of the change in the fundamental analysis, the rate cycles. I mean, rate cycles at the central banks are and always have been, they remain so, the largest determinant with the greatest correlation of currency levels. Even though that fundamental picture had clearly changed, until this is played out, which it mostly is now. After all, what is this chart telling you? That there's essentially no difference in risk between Italian government bonds and U.S. government bonds. Is that an analysis that any type of economic analysis can support? Population analysis, demographics, anything tells you that that's the case. No, except that Mr. Draghi has convinced the markets that it is so, or at least in any time frame that matters to a portfolio manager, it is so. Does that mean in 10 years it's going to be so? I have no clue. When my girls are grown up and in college in 15 years, does that mean it's going to be so? I have no clue. But in the time frame that matters to the markets right now, it is true, and the markets have become convinced of it. So when should this support for the euro erode enough so that the euro can, in my mind, reach a more palatable level considering the change in fundamental bank policy? To me, that is about where we are now. So now, all the way back to trade prep. Where would we, if we're trading euro, what are we going to do? Where do we look? So let's get a little closer in the analysis here. Let's zoom in a little bit. Let's take this period here. The last time we were down at this level. So the only two real points we have right now are this one right here, which was 03. And that was earlier in the month. And this one down here, which is 77, which is the low for the year. So certainly we can posit those two as points of potential acceleration in trading, euro on the downside. So let's draw those in. Horizontal line, this one right here. That is 02. And this one right here, which is 77. Okay, we can see that 77, we can see that 02. Those are the two immediate points now. Now the euro has been dawdling. Take this right here. Sure looks like it wants to go lower, doesn't it? But the euro's been dawdling right around here, not approaching this level. Not seriously, anyway. We only go back to 3. And this was, of course, on the ECB rate policy day. And this, if you look at a candle, means that the downside was played out That's what this long shadow beneath means, and that we are headed higher. They couldn't get any energy here, and it snapped right back. That's absolutely true. We did go higher, but again, we are approaching the decision point. So, initially, now where are we in the euro right now? 35.37. And if we let's take a look in the euro at a, and this is something else I like to do, as well as looking for all sorts of reinforcement for any particular trading idea across indicators and different types of charting systems, oscillators. I also like to look across time frames. Oops, again, wrong channel. Hold on. Okay, so let's look at the euro here. I'm going to put it into, the system is very easy to use. My ex-mayor, he has got a great system here. Okay, so let's put it into candles, which I happen to like, maybe because I'm sort of friends with Steve Nissen. Okay, so now let's not look at the dailies. Let's look at hourlies. For me, I never think that taking charts much lower than hourlies are particularly useful. There's far too much noise for my mind if you go beneath. If you want to look there and see what's up, that's fine. Let's take a look at a different support, a different way of looking at supports here. Okay. Let's see if we can get a channel here. I happen to like channels. And then we'll do this one here. Now, we can do this channel two ways. This is the one that I would use. I would ignore this point here. As a matter of fact, this is the volatility after the ECB. So I tend to ignore that. So we have on this one here, I have a feeling I'm only going to get to the euro. So I'll have to talk about the euro. If anyone has any particular questions about other currencies, just put them up and I will talk about them. So this is right here, we're looking at some support, we think, at 35.03 and at 34.77. Those are immediate points, and they're based mostly on lows. Not mostly; those are two of the recent lows. This one is probably more important because it's for the year. So let's see if we get any support in the hourlies on that. Okay, so this chart here is crossing. We're right here right now, right? 9 o'clock. So the support in this chart is about a little bit lower at 93. This is an hourly chart going back to 2 months. Now let's see if we can get a little, see if this gives us any better idea. No, before that, the down channel part starts right about here, just like we'd expect. Now, if we use this point here, we would get a much more angled down channel, which I don't really want to do, because I prefer to give the channel a fuller basis in analysis, meaning it has more data points on either side of it. You start up here, you're going to get a channel that goes like this, and the bottom part is going to be much steeper. So you look for as much concordance with your statistics, with the drawing patterns as you can get. So we have the other point at 503. And then we have what appears to be today about 93. Which one of these is probably a stronger support? I would bet that the 03 is probably better, but you're going to get some support from this. This is just the hourlies. Okay, let's move up a little bit and look at 4 hourlies, 30 days, 240 minutes. Okay, there we go. Same time frame. And you know we're showing, of course, what we'd expect, the same pattern. What's that? That is a different pattern. Okay, I don't know exactly what that is, but I will get rid of it and start again. There we go. Okay, so take that as one pattern, and again, use this here. The charting's a little bit different, but you can make the same idea. Again, so we're seeing at the daily, this one's a little higher. So far, we're seeing support somewhere between, say, 90 and 05. And that's exactly what you'd expect. Now, as far as where you put your entry, my choice would be, I mean, if you decide that this is the trade that you're looking for, and I would look for it, because this, remember, behind what we're talking about is the scenario of the change in the general attitude of the market towards zero. It has not affected itself yet, so that this is a full-blown move. It's my mind, to my analysis, it will be. I mean, my own system has been short for some time. And I actually wrote it quite a ways in the wrong direction here. But if you look at where the euro is going to go in the next 6 months, it's very, very difficult, I'd say impossible, to make a case that the euro gets stronger. Because what would you base it on? There isn't anything to base it on. Is the European economy suddenly going to get better? Doesn't seem like it. Is the European central bank suddenly going to start raising rates? Doesn't seem like it. Are they going to eliminate what they just started, which is negative interest rates? Wouldn't think so. Is the U.S. I mean, the only so the Europeans are kind of set, it seems, for the next 6 months is where their policy is going. You can make an argument, not a strong one, but you can make an argument that there is potential for change on the U.S. side. And that will depend, of course, on the U.S. economy not performing. It is certainly possible, although I think unlikely, that the Fed halts the taper in quantitative easing. I don't think it's very likely. We'll know better. A lot of the statistics seem to be pointing towards a stronger U.S. economy. We don't have GDP figures. I mean, I think I put out a note yesterday that both J.P. Morgan and a company called Pierpont Securities have taken a healthcare number that came out yesterday as part of the quarterly statistics survey from the Census Bureau, where healthcare spending was much lower than expected. That will mean that GDP in the first quarter is probably not negative 1%, but maybe 1.5% or negative 2%. Does that mean that there isn't going to be a strong snapback? No, of course not. But it does mean that the overall GDP for the year will not be able to reach the Fed's low. Remember, the last meeting, the Fed put in a 2.8 to 3% estimation for the GDP this year. That's not happening. If you get a negative 1.5 or negative 2% GDP in the first quarter, it becomes not quite statistically impossible, of course, but realistically impossible for the U.S. to grow at the rate necessary in the remaining 3 quarters of the year to produce 2.8% GDP. So if, in fact, instead of the hoped for 3 or 3.5 or even 4% you get in the second quarter, you get something like 2.5, then again, U.S. GDP is going to be probably around 2 or lower for the year. If that continues, is that the type of statistic that might stop the Fed's taper? It's possible. I don't think it will. After all, once the Fed's on a program, and they don't like to change it, although the Fed certainly did that last fall in October, in the Bernanke slap. But that was basically at the credit markets, which we thought were getting ahead of themselves. So there isn't a great deal of possibility that might happen, but it is possible. There are, of course, other things going on in the world. Anyone look at oil prices today? Prices are much higher. And why are oil prices higher? Well, we all know why. Because there is warfare in the Middle East. There's warfare specifically in Iraq. And I believe one of the larger oil production facilities in Iraq has been overrun by militias opposed to the current Iraqi government. Oil from that facility is going to cease, or it hasn't already. That is certainly enough to send oil prices much higher. And whatever you want to say about the U.S. economy, may be performing better than Europeans, but it's certainly not strong. And that type of drag, after all, higher oil prices are nothing but a consumer tax on the U.S. economy, is certainly enough to send the economy into or to diminish consumer spending and all sorts of other things. Okay, let me stop here for a second and see if anyone have any other questions. I think we're running 45 minutes today, and we're a little bit over here. Let me just check with the administrator and see. Okay, everyone give me about a minute, and I will be right back here. We'll just check on this. It's been very reluctant to move, but it has the greatest potential, I think, of most of the currencies right now for a prolonged switch, for a trend, and for a potentially profitable trade. The reasons, the most profitable trades, and the ones that run the longest, are where you have a change in the basic scenario. Your inception points and your exit points are still determined by technical analysis. But the potential, I feel, in the euro is at least back to here. There are two other points I want to make here, and then we'll wrap up. Markets have an inordinate affection for round numbers. Must be something very human. I'm not sure what it is. If I were looking for this trade, I would be shorting somewhere either just above or just below 135, the figure. For a short-term trade, if it bounces off 77, you might consider changing. But the more important line is here. This one right here, this long-term trend, which is 2 years in the making. That point is here, about 134, 40, 50. That is the line that I would look for both acceleration and where I would consider, if it bounces and bounces strongly, especially if it bounces back above 35 after coming down here, to perhaps cut the position if you're short and start over. But this here, this right here, is what I would say is the key point in this trend. And if you look at this Zoom place, you're looking about 134.50. So if you want to be conservative on this trade, rather than taking the position here, as with a long-term trend, take the short above the trend line, which would be about somewhere between south, say, of 134.75 down to 134.50. And this is your decision point right here. The reason is you do not often get setups that are this close to a potential change in a 2-year trend. Okay, folks, I thank you all for attending. I'm sorry we didn't get to the other currencies. As I said, if anyone has any specific questions, I will put my email address up there. Please mail them to me. I'll be glad to. Also, next week, I will begin. I used to write a column every week called Market Directions. I will be resuming that on it'll be posted next Thursday. I write the columns on Wednesday. And if you're interested, I'll be glad to send that to you. Just send me your name and I'll add you to the list that I send out. Again, thank you all very much. Thank FX Street for their facilities and their marketing to get this done. And we will see you again in about a week and a half when I have another webinar. I have not decide on the topic. Consider I didn't get to the other 3 currencies I want to talk about today. Perhaps we will do another trade prep webinar next week on the currencies that I did not, and perhaps any that any would like to hear about. Again, thank you all very much for attending. I take it as a great compliment that you take time out of your day to listen to what I have to say. Good day.